So if you've been watching the real estate market and the mortgage market with the interest rates, it might feel like it's an impossible mission to buy your first house. And I would say, yeah, it is very challenging, but it's possible. It's absolutely possible, even for a young buyer. If you're 18 to 26 and you're still planning for that, it's absolutely possible. You can do it. Just takes a lot of planning, a lot of discipline. It can be done. It's getting more difficult. But in order to help you plan, I wanted to share, I've been doing lending, mortgage lending for almost 30 years. And so what does it take? What does a lender look for? How do you get qualified for a loan so you can take advantage of getting a home? One of the greatest ways to increase your wealth and your net worth is to own real estate. It's a huge benefit. It's about one of the only things that keeps up with inflation. So behind the scenes, what does it take to get approved for a mortgage loan? It's the elementary things that a lender looks at are the 5 C's of credit. And it's not just a mortgage loan, it's for a car loan, it's a credit card, anything you might apply for. They're looking at these qualities, these 5 C's of credit. And banks and credit unions, brokers all use the same thing to determine if you're credit worthy. And especially if you're looking for your first home, they look at these things with a lot of weight. So what are these? Your character, your capacity, your capital, the collateral, and the conditions in the market. One thing to think about is if you're having a hard time getting qualified, is there might be options with a bank and credit unions. They might be more flexible in helping a first-time home buyer get into a home than what just a broker does. A broker has relationships with maybe a half dozen or a dozen different lenders, big banks, US Bank, Wells Fargo, and they all have very defined limits in what they can do. Because banks and credit unions are a full service, they take deposits, full service financial institution. They can lend out their own money. These are called portfolio loans, and sometimes they're more flexible. So something to keep in mind. So character, when you apply for a loan, they don't have you come in person and sit in front of a panel of underwriters and get grilled with questions. They're going to take what's on paper. All of your character ends up on paper. How do they determine what kind of person you are? Well, number one of the highest things they look at, one of the greatest things you can do is pay your bills on time and aim to start developing a credit score. Aim for a credit in the higher 700s, 750 plus. What is a credit score? So credit ranges anywhere from on the low end to 400 to 850. Never seen one that high, maybe 826, 830 is the highest I've ever seen. But anything in the high 700s will get you a best rate, 750 plus. And what are they trying to predict? A credit score is trying to predict your future behavior. What kind of person have you been in the past? Are you disciplined? They're trying to predict, are you on the road to bankruptcy? They've done studies. They know how people act when they're starting to prepare for bankruptcy. What are the red flags? One of the first things they do is they go up and they charge up a bunch of credit cards. They charge them up to the limit in preparation for bankruptcy. So the higher credit card balances you have, the lower your score will be because they're thinking you're planning something. It's a prediction model. It's a model of what they think you're going to do, how reliable you are. So bottom line, pay your bills on time. Job and address history. 2+, they're going to ask for 2 years of job history. If you don't have that, schooling counts towards that. But if it makes sense, it makes sense. Yeah, I've been on the job for a year, but I was in school for a year previous to that, getting a degree or some internship. Well, that makes sense. No problem. But are you someone that every 6 months you move and you get a new job? That's an issue. That's a problem. How reliable? Consistency equals trust. And going back to credit, Start earning credit as soon as you can. It starts at 18. Before that, you're a minor. You cannot sign a contract. Start at 18. Go into a bank or a credit union, a local one. Start a relationship with this bank. Say, hey, I've got $2,000 saved. I'd like to open a secured credit card. You don't have to carry a balance. You can use it for gas and pay it off every month. But that will start your credit. So secured means I deposit $2,000 in the savings account. They put a lien against it. They put a hold on it. So you can't use it. Still get paid interest, but you're building and using that credit card, still building in, credit with that secured card. Need a small car loan. I'm gonna buy a car for $10,000. I can put half down. Will you loan me the other half? Even without credit, most places will give you a shot with putting half down or a huge deposit. Another tip is there's options. You can follow this link. I'll put it in the description field to getting people to report on your credit. I'm paying my cell phone bill on time. I'm paying my rent, my insurance on time, and that'll help your credit score. I would start with the basics though. Secured credit card, a small car loan, and then you can do this later down the road. But tip, do not use, if you get that credit card, more than 45% of that line of credit. Matter of fact, find out when they report. Say their cycle runs from the first of the month through the end of the month. Whatever balance you have on the 30th is what we report on the 5th of the following month. Make sure your balance is paid down to zero. Don't ever carry a balance. Don't pay interest. Capacity. They're looking at, can you afford this payment? How do they determine if you can afford it? Well, they look at your debts, all of your debts with the new loan, and then they look at your income, how much you make a month. But they're looking at your gross income. That means before taxes and any deductions. So as an example, let's say you make $10,000 a month. That would be nice. And let's say all of your debts together, including the new house payments, $4,500. You would qualify. They say, yep, you qualify. But you have to keep in mind, they don't add into that cell phones, utilities, food, insurance, repairs on cars, all the incidentals. The only thing that shows up in that debt to income ratio is what's on your credit report. And those are like credit cards and car loans. So in order to afford more of a house, pay down any debt you have, pay off the credit cards, pay off your car. The other thing is you have to figure this out on your own. They might tell you you can afford $4,500 or $3,500 payment. But they're using income you don't have. They're using your gross income, not your net, what you take home. Yeah, sure, I might gross 10,000 a month, but after taxes and all their deductions, I might only get like 7,000 a month. And they're not counting the bills that you have that aren't on the credit report, your cell phone, and all those things. So they might tell you can afford 3,000, but once you sit down and do a budget, I could really only afford maybe 2,000 a month. Capital, what is in your wallet? How much money do you have saved? Investments, down payment, all of that matters. If you're putting money into a 401k, that will help you qualify for a loan. If your company matches 401k money, it's a great option. Say you put in 6, they match 3 of it. That's free money, and it helps in qualifying for a loan. Say, well, this guy's got $20,000 in a 401k. If something happens, some emergency, we know he can take that money out. You have to pay penalties and taxes on it, but still he'd have money set aside for reserves. Reserves usually means, do you have 6 months of payments or bills set aside besides your down payment? So if your payment's 3,000 a month times 6, do you have 18,000 or so in a 401k? Yeah, absolutely. You probably could. Of course, the more money you save, the better. And then here's 4 loan options. I'll go through in a little more detail in the next few slides. But yeah, there's conventional is the best way to go if you can do the 5% down. FHA, oops, and VA are great options. USDA is a great option. We'll go through that. But for sure, try to save up as much money as you can, especially while you're living at home, have low expenses. Shoot for that 5% down plus reserve money. One thing to think is don't save up money at home. It's not good to have cash at home. It's not insured and you don't get paid any interest on the money. Someone steals your money, you're just out. And it'll require, if you like save money for a year all in cash and bring it all in, they'll ask where it all came from because they're suspicious of any large cash deposits. So you'd have to let it sit in an account for at least 2 months a season. Collateral. And what is the home? That's the fourth C. What is the home worth that you're buying? Of course, the lender. I'm sorry. Let me back up. So the home that you're buying is the collateral. Of course, the lender puts a lien against the home. So if you don't pay, they take it from you. They go through a foreclosure process. But while you have a loan, you are required to keep fire insurance on it. If the house burns down, they want to make sure they get their money back, which is different than the mortgage insurance, MI. Two types of insurance. So fire insurance kind of protects you in the house in case something happens. Mortgage insurance protects the lender if you default, if you stop paying. Let's say you owe $100,000. You stop paying. They take the house back and sell it for $75,000. They're short $25,000. This mortgage insurance you pay every month insures the lender. Say, hey, lender, thank you for taking this risk. We're going to insure the home against default so that if they don't pay, you can get your money out of the property. So it's not a good thing. I mean, for you, it doesn't help. It helps you get a house with less money down in that sense. But as soon as you can, you try to get rid of it by refinancing. If your balance of your loan goes down so that you have 20% equity, or if your balance comes down or if the property appreciates. So equity, that's the difference between what you owe and what the property is worth. So it's very important to understand, how an appraiser would come up with a value on your home. What does an appraiser do? So if you're looking at buying a home, they'll send an appraiser out to look at the house, do an inspection, and then he'll get back to his office and he'll look at all the homes within a 2-mile radius of the one you're buying, and look at all the homes that have sold in the last 6 months and see what they sold for and how they compare. How many bedrooms, how many bathrooms, how many square feet, 2-car garage, 3-car garage, whatever it is, and make adjustments. And then they figure out a value based on what's sold in the past. So here's the key though, tip number 2, if the property doesn't appraise for what you're paying for it, you pay the difference, or the seller has to drop their price. So kind of an awkward position. That's why it's great to have a real estate agent to help you through the process. On the lending side, we only take the lower of the two. If the house appraises for 100,000, you're paying 100,000, that's great. If it appraises for 75 and you're paying 100, then you've got a problem. You either pay the difference or you get the seller to drop the price. If they won't drop the price, then you walk away and you have an agent write up the contract so that you have these options to get out of the contract if it doesn't appraise. So it's very important to have a seasoned agent help you through the process. So the final C, conditions. What's going on in the world? Lenders look at the economy and loan terms. They look at, interest rates, employment trends, inflation. one thing to keep in mind is, what's going on in the market. And it's like I say, it's good to use an experienced agent so that make sure you're getting a good deal. They can give you a CMA, comparative market analysis. It's kind of like the same thing as appraisal. And they can tell you if you're getting a fair price for the home. They can help you with negotiations if it doesn't appraise, or if there's some repair issues, they can help you with negotiations and getting the repairs done. So one thing to consider, if inflation is going up, rates will follow. Mortgage rates will be right, they go up. But the thing to consider is if you find a great house at a great price, it's best to date a rate, but marry a house. Don't wait. You might not like the payment's not exactly where you want it, but the house is the right price. It's great to lock in that house at that price. You can always refinance down the road. So this stuff matters. These 5 C's, and it determines if you'll be approved for a loan or not. If you've got strong credit, you'll get lower rates, interest rate, you'll get a lower rate on a mortgage insurance. You'll be able to afford more house for your money. Work on all 5 of these. Be a solid borrower. You'll get a much better house. But in order to get this done, you have to plan ahead. When's the best time? Start planning with your first job at 16, 17, 18. Get a good, reliable car and start saving for a house. But part of this equation doesn't hurt. You're 18, 19, call a mortgage lender. Say, hey, what should I start doing? And they can help you through the process. So here's an example of what you might get from a lender. This is kind of a worksheet showing what a payment would be based on 6.75, 5% down, conventional loan. Here's what a payment would be, principal and interest, $1,800. Mortgage insurance, like I was talking before, $57 a month. Property taxes, you got to pay property taxes. That might be a little high on a $300,000 house, but this is an example. Insurance, what does it cost to insure the place? That might also be a little bit high, but this one's low. It's not going to be, most of the time, if you're buying something in the $300,000 range, probably buying a townhome or condo that has an HOA. It's going to be more than 10 bucks. So be more like probably 110. So this payment would be 22.10. So here's a summary of the transaction. You're buying something for 300, you're getting a loan of 285, 15,000 down. You've got some prepaids that I'll go over in a second and some closing costs. So total cash to close 23,000. But here's something interesting to think about. Could I afford a $2,200 payment? To qualify for that payment, you would need to make about 5,000 a month. Because that's, take 5,000 times 45%, going back to that debt to income ratio. That's a payment of 2,200. That's all of your payments together. If your car loans, credit card, it's a new loan, it could not exceed that. So in this scenario, you couldn't have any other debts. Here's something to consider. You might think that's painful. I'm only paying, $1,000 a month in rent right now. Why would I want to go to 2,200? Well, get this. What if you bought something that's got 3 bedroom, 2 baths, and you rented out 2 rooms, 500 a piece? You get $1,000. Suddenly, this payment, 2,200, becomes 1,200. Not much more in your rent, so options there. So if we break down closing costs, this is pretty standard. Underwriting processing fee to get the loan underwritten and processed, $1,200. Origination fee, that's 1% of the loan amount. Pretty common. In our case, it helps buy a rate down, get a better rate. Here's some other fees: flood insurance, tax service, credit report, appraisal. Got to pay for all that stuff. So these are closing costs. This is money they set aside in advance to pay your taxes and insurance. It's called an escrow account. Your taxes come due once a year. Your insurance comes due once a year. It's like a savings account. They add it to your payment every month. So they're going to collect for that first year and then start accruing, first year of insurance, and then start accruing for next year's bill. It's called an escrow account. Title insurance. You've got to have, every lender requires title insurance. And it's part of closing costs. What is title insurance? Let's say you get into your brand new house and you're super excited, and then like a week later, you get a knock at the door. And someone says, "Hey, thanks for moving in. Notice you just moved in. Hey, but the previous owner had me put a brand new roof on this house and they never paid me. And you owe me $50,000. You're like, "What? I don't think so. I wasn't me." Well, they could sue you and get that money. It'd be a very sad day. Title insurance, what that is they're ensuring that the lender will have first position on that house over any other liens. They've searched records. They're saying this is clear title. Taxes, there's no other liens that will go ahead of it. If someone comes back and they miss something, like that roofer, you say, "Let me call the title company." Or you'd say, "Well, let me call my lender." And then the lender would call the title company and say, "Hey, we've got a claim here. You might have missed something. This roofer said he was never paid." And if they missed it, you paid insurance at closing to make sure that there's no other liens. So you wouldn't have to pay that 50 grand. The title insurance company would, because you bought insurance. So it's required. There's some benefits. It's just, all of this is expensive. But going back to this origination fee, you don't have to pay that. You say, "Hey, lender, I don't want to pay that." And they say, "Okay, no problem. So instead of paying 6.75, I can raise your rate to 7%, and then you don't have to pay this." This is like you're prepaying interest. What are your plans in that home? And am I going to be there for 10 years till I'm ready for a second, nicer house? Or am I going to be there maybe for 2 or 3 years until I think rates are going to come down? If that's the case, you might not want to pay it. So if I took a 7% rate, your payment would be $18.96 instead of this payment, $18.48. So it's a difference of $47 a month more. Does it make sense to pay that $2,800 up front so I could get $47? So, hey, I'd take that deal any day. Give me $2,800 right now, and then every month I'll send you a check for $47. Would you take that deal? Well, if you do the division, the math, it would take you, 60 months to get your 59 months, 5 years to get your money back. So here it is all broken out. Month one, yeah, I got to pay $47 more. Yeah, in 10 months, I paid $407 more. But I didn't have to pay the 2,800. I don't know if this makes sense. So you add up all this, you get down here at the bottom. I'm going to try to make this bigger. Yeah, 60 months. You paid $47.61 more a month, which adds up to be $28.56.60. You paid up front $28.50 for that lower rate. So you break even. So it makes sense. If I keep that loan for 70 months, yeah, I just got $470, right? 10 times the $47. But if I sell the house in 3 years, or if I refinance because rates come down, that doesn't make sense. I left money on the table. I prepaid a lower rate and didn't get all my money. So it's just something to consider. Hope that's not confusing. I tried to make it simple, but what's the break-even point? Ask the lender that. So let's compare a couple loans. Like I was saying before, the conventional FHA and USDA. I couldn't fit 4 on here. Maybe I could, I just didn't. Anyway, so what's the payment? I even did 6.75 on the conventional, and then lower rates, which is usually the case, 6.5 on FHA and USDA 6.5. Look at this. I put a little bit more money down. My payments, the lowest one on here, 2110 versus 2198 and 2207. But here's a big thing. Look at this mortgage insurance, only $57 a month versus 132 versus 87. Yeah, FHA is great. I mean, 3.5% down instead of 5. Look at that. At the bottom line, 23,000 down versus 19 versus 86. Yep. It's a great deal if you can find a property that's eligible for a USDA. It's a rural loan. So that means you have to go to the internet, type in USDA eligibility uh, map, and you type in an address, and it'll tell you if it's in a qualified area. But yeah, it's nice to have 100% down or 100% financing. But yeah, your cash to close is much lower, and this might be the best option for you. But be aware. Look at this fee, $3,000 fee just for the loan. Be aware, FHA. Well, look at that fee, upfront fee, $5,000. It's added to the loan. It doesn't help you. If you can save up a little bit more money, $23,000 sounds like a lot, but sometimes the seller will help you with the closing costs. Here's 8 grand. So that means you're only putting, 15 down if they pay the closing costs. This is the best deal if you can do that. But maybe you decide I want to get into a home now. I don't mind paying the 3 grand. Yeah, then do that if you're living in a rural area. Great option. Just be aware you're paying fees in these two loans that you don't have to on this one. And going back, well, what about I'm a first-time home buyer. I hear that all the time. What deals are out there? Yeah, sure, the government does have deals. Local counties have deals, but that comes and goes. Don't expect a handout from the government. Don't expect that money to be around. They have limited access to that money. Plan for this first column, and if they have something great. Most first-time homebuyer programs, no money down equals higher payments. You might have a first mortgage at a lower rate. Second mortgage might not require any payments, but when you sell the house, they'll collect that money. Or it might have a payment with a higher rate. So it usually means higher payment. Bottom line, take action. Check your credits. You start to build your credit. Make sure everything looks good on there. Check your credit annually at annualcreditreport.com. And this is key. If you Google annual credit report, like 6 different sites come up. They're all trying to get you to go to their site. The only source for your free credit report authorized by federal law. Annualcreditreport.com. Go there. You can get the report for free from the 3 bureaus, Experian, Equifax, TransUnion. You get all 3 of them. They won't give you the score. You can get that if you pay like $7, but you don't have to have that. Good to verify what's on there on your credit. Number 2, track your spending. Create a budget. Save money every month. Well, I can't come up with $23,000. Are you kidding? Yeah, in 1 month you can't. But what if you could save $1,000 a month? It's going to take you a couple of years. You can do it. You can do it. Start saving for your down payment. Learn about the different options. There's some great options out there. Oops. So basically, these days you have to start early. Your future will thank you. You have to plan ahead. Requires more planning. You can do it. It can be done. Let me know if you have any questions. I'd be glad to help. If you email me a loan estimate, I'd be glad to give you any advice I can give without any obligation. I'm here just to help, not, but it is my business. I have to have a disclaimer. I will glad to help, but I'd love to help you get a loan too. But bottom line is, I hope you found this helpful. Let me know if you have any questions.